The Japanese yen is shaking quietly at first, then violently. One of the most stable currencies in the world is sliding to levels not seen in decades. In behind that fall is a storm of politics, power plays, and rising global tension. This is not just another market dip. This is a warning signal coming from the heart of East Asia, and it is flashing red for the entire world. When we say the yen is collapsing, we do not mean it has disappeared or has become worthless overnight. A currency collapse in this case means Japan's money is rapidly losing value against major global currencies like the United States dollar. This makes everything Japan buys from other countries more expensive: fuel, food, technology. At the same time, it changes how investors, governments, and rival economies respond. The problem is not only economic, it is strategic. Because when a major economy weakens, others do not just watch, they react. And China is reacting. While Japan struggles to defend its currency, Beijing is sending sharp warnings, not with tanks, not with missiles, but with financial signals, policy shifts, and quiet moves inside the global money system. Behind closed doors, China is working to reduce its dependence on the dollar and challenge the dominance of the G7 financial order. This makes the yen collapse more than a local issue. It becomes part of a larger battle for influence over the future of global money. Here's the part many people are missing. A weaker yen helps Japanese exports, but it hurts Japanese households. Prices rise, wages struggle to keep up, living costs get heavier. At the same time, Japanese companies that depend on foreign materials pay more. This creates pressure inside Japan: political pressure, social pressure. And when pressure builds inside a major economy, it affects its decisions abroad. This is where geopolitics enters the picture. Now, connect this to China. Beijing has spent years building its own trade networks, payment systems, and currency influence across Asia, Africa, and parts of Europe. As Japan's currency weakens, China sees an opportunity not just to gain economic advantage, but to reshape how money flows globally. This is not being done with loud announcements. It is happening through slow policy changes, trade deals, and financial realignments that most people never hear about. In this video, you will learn why the Japanese yen is falling and what forces are pushing it down. You will understand how China is responding behind the scenes and why its moves are starting to worry global powers. You will also see how this situation could impact global trade, energy prices, investments, and even the value of currencies far away from Asia. Most importantly, you will discover how this is connected to a bigger shift in the global financial system where power is slowly moving away from traditional Western control. There is one reason you should watch this until the very end. The final part reveals the possible future outcomes of this situation. Not just one, but 3 realistic paths the world could take if this currency conflict keeps escalating. Each one carries very different consequences, not just for Japan and China, but for everyone connected to the global economy. If global finance, hidden power struggles, and real-world economic shifts interest you, then this video is for you. Stay with us because this story is still unfolding, and the next moves could reshape the financial balance of the world. Welcome to our channel where we break down complex global events in a simple and powerful way. If you want to stay updated on geopolitics, economics, and the forces shaping the future, make sure to subscribe and join our growing community. For years, Japan followed a very different path from the rest of the world when it came to interest rates. While other central banks raised borrowing costs to cool inflation, the Bank of Japan kept its rates near zero. Some of the time, they were even negative. The goal was simple: force money into the economy, encourage people to spend instead of save, push companies to invest instead of holding cash. But this long-term policy created deep side effects. It made the yen less attractive to global investors. When investors can earn higher returns in the United States or Europe, money flows out of Japan. As that money leaves, the yen weakens further. This policy did not come out of nowhere. It was born from Japan's long battle with deflation. For decades after the asset bubble burst in the early 1990s, prices barely rose. Sometimes they even fell. Companies earned less. Consumers delayed spending, waiting for prices to drop again. Economic growth slowed. Wages stayed flat. The entire economy entered a cycle where low demand led to low growth, and low growth reinforced weak demand. The central bank tried to break this pattern by flooding the system with cheap money. But the deeper problem was structural. An aging population, falling birth rates, and a shrinking workforce all reduced long-term economic momentum. Now, another problem has entered the picture: inflation, but not the healthy type driven by strong domestic demand. Much of Japan's recent inflation is coming from outside because the yen is weak. The country now pays more for imported energy, food, and raw materials. Oil becomes more expensive. Gas prices climb. Basic goods cost more. This pushes up overall living costs even though wages do not rise at the same speed. The result is pressure on households and small businesses. International institutions have pointed out a difficult balance. A weak yen makes Japanese exports more competitive. Cars, electronics, and machinery become cheaper for buyers abroad. This supports large exporters and boosts overseas earnings. But at the same time, it raises the cost of living inside Japan and increases financial vulnerability. If global investors lose confidence, the currency could weaken further. That would increase import inflation, push debt servicing costs higher in the long run, and limit Japan's future policy options. The central bank now stands between two fires: protect growth or protect the currency. Knowing that each move carries a price, the yen has been sliding with a speed that has shocked even veteran market watchers. It has touched levels that were once considered unthinkable for a major developed economy. What makes this more dangerous is not just how low it has gone, but how unstable its movement has become. Some days it drops sharply, then bounces back only to fall again. This kind of volatility tells a deeper story. Investors are no longer sure where the floor is. They do not trust that the current level is the bottom. When a currency starts behaving like this, confidence becomes fragile. And in global finance, confidence is everything. Japanese officials have not stayed silent. In recent months, government leaders have openly warned that they are ready to step into the market if the fall becomes disorderly. This is known as foreign exchange intervention. It means selling foreign reserves like United States dollars to buy yen and support its value. Japan has done this before, but it is not something they like to repeat often. It is expensive. It drains national reserves, and it only works temporarily if the underlying economic forces stay the same. The warnings are meant to send a message not only to traders, but also to speculators who try to profit from driving the yen lower. At the same time, the Bank of Japan has started shifting its tone. For years, it refused to even talk about raising interest rates. Now, its language is changing. Officials are carefully signaling that a rate hike may come if price pressures and currency weakness continue. But this is not an easy decision. Raising rates could strengthen the yen by attracting more foreign investment. However, it could also slow down Japan's fragile economy and increase the cost of borrowing for businesses and the government, which already carries massive debt. This leaves Japan stuck in a narrow corridor. Move too slowly and the yen keeps sinking. Move too fast and the economy could stall again. Meanwhile, global investors are watching every speech, every policy statement, every small hint. Even a single sentence from a central bank official can move the yen in seconds. The result is a currency caught between market fear, political pressure, and the fear of making the wrong move at the wrong time. As the yen weakens, analysts are paying close attention to how China might respond in currency markets. Weakness in one major Asian economy can create cover for another. A cheaper yen makes Japanese exports more competitive. To protect its own industries, Beijing may allow the yuan to weaken as well, not through dramatic devaluation, but through slow, controlled adjustments. This keeps Chinese goods attractive in global markets without triggering panic. It is a quiet strategy, one that does not rely on headlines but on steady pressure through monetary tools and policy signals. This behavior is not new. China and Japan have a long history of watching each other closely in currency matters. When one adjusts, the other often reacts. In the past, periods of yen weakness have sometimes been followed by softer yuan policies, not always openly, but subtly through market guidance and exchange rate bands. This creates a risk of competitive devaluation, where countries lower their currencies to gain trade advantage. The danger is that once this cycle starts, it becomes hard to stop. Each move forces a countermove. Each decline invites another. Behind this technical currency battle is a much bigger ambition. China is not only focused on trade competitiveness, it has spent years building parallel financial structures, from expanding its own payment systems to promoting the use of the UN in international trade deals, especially in energy and raw materials. It is strengthening regional financial ties across Asia, the Middle East, and parts of Africa. Many of these deals reduce reliance on traditional Western-dominated financial channels. This is not accidental. It is a long-term effort to shift influence. A weaker yen makes it easier for China to push this agenda. Japan, once Asia's financial leader, now finds itself under pressure. Regional partners see Beijing as more stable relative to Tokyo's currency instability. This changes negotiations. It changes trade flows. It changes financial loyalties. Quietly, step by step, it alters the balance of economic power in the region without needing a single formal announcement. When people talk about flipping the G7 system, they are not talking about a sudden overthrow. They are talking about a slow shift in how global money power is distributed. For decades, the G7 countries controlled most of the rules, institutions, and flow of global finance. Their currencies dominated trade reserves and international loans. Flipping that system means reducing this dependence and building alternatives that work outside that traditional circle. China is using its regional influence and currency leverage to move in that direction step by step. Currency leverage means using the value, stability, and circulation of your own currency as a tool of influence. When China signs trade agreements in which payments are settled in UN instead of United States dollars, it reduces the role of Western financial infrastructure. When it encourages central banks in Asia and beyond to hold more UN in their reserves, it slowly increases its role in the global reserve system. These moves may seem small individually, but together they create a new layer of financial power that does not run entirely through the G7 system. Historically, the major powers have tried to avoid open currency conflicts. G7 nations have often released coordinated statements urging countries not to weaken their currencies on purpose for trade advantages. These agreements were meant to prevent economic chaos like in the 1930s, when competitive devaluations worsened the global depression. But as the world becomes more fragmented, these old understandings are weakening. Emerging powers do not always follow rules that they did not help create. China's ambition goes beyond trade and reserves. It is investing heavily in regional financial infrastructure, cross-border payment networks, digital currency experiments, bilateral swap agreements with central banks across Asia and other regions. These tools allow countries to trade and settle deals without passing through traditional Western banking systems. Over time, this builds a parallel architecture. The risk here is growing fragmentation. Instead of one connected global financial system, there may be several competing ones. If currency tensions rise, this could turn into a new type of currency war, not fought with rapid devaluations alone, but through influence, alliances, and alternative networks that slowly split the global financial order into blocks. Inside Japan, the weakest link in this situation is not the corporations or the banks. It is the ordinary household. A cheaper yen means everything imported becomes more expensive. Energy bills rise because Japan depends heavily on foreign fuel. Food prices climb because large portions of agricultural products and animal feed are imported. Even basic daily items see slow but steady price increases for families whose wages have barely moved for years. This creates quiet financial stress. Savings lose purchasing power. Monthly expenses stretch further. The pressure builds not suddenly but silently, and that is what makes it dangerous for the broader Japanese economy. The tools available to fight this weakness come with heavy costs. Currency intervention requires using foreign reserves, which are not infinite. If the government steps in too often, markets may begin to test its limits. Each wave of intervention can calm markets for a moment, but it also increases volatility if traders start betting against future moves. This turns into a cycle where stability becomes harder to maintain. Meanwhile, higher interest rates, if introduced too quickly, could slow corporate investment and increase the burden of Japan's large public debt. The impact does not stay within Japan's borders. Asia is deeply connected through trade, supply chains, and financial flows. A sliding yen affects exporters and importers across the region. Some economies benefit from a weaker competitor. Others suffer because their own currencies are pulled into the turbulence. Global investors sensing uncertainty may pull money out of Asian markets to safer assets, increasing pressure on emerging economies and their currencies. This kind of movement spreads faster than headlines. It can destabilize entire markets in days. On a strategic level, the shift is even more serious. As Japan struggles to stabilize its currency, China gains leverage not through force but through opportunity. Financial weakness becomes diplomatic weakness. Trade negotiations shift. Regional partners hedge their bets. Power balances adjust. Quietly, Japan finds itself more defensive, while China finds itself moving forward in a system where economic strength defines influence. One possible path is that Japan acts decisively. The government steps into the currency market and the central bank finally raises interest rates with confidence. This sends a strong signal. Investors see higher returns in Japanese assets. Capital starts flowing back in. The yen stabilizes. Volatility cools down. Import prices stop rising at the same speed. Households feel a little less pressure, but even in this scenario, the cost is heavy. Higher rates increase borrowing costs for businesses. Government debt becomes more expensive to manage. Economic growth slows before it finds a new balance. Stability is achieved, but at the price of short-term pain and long-term restructuring. Another path is more chaotic. Japan delays its response. The yen continues to slide. Inflation deepens because imports keep getting more expensive. Energy costs remain high. Food prices keep rising. Wages fail to keep up. Public frustration grows. Political pressure increases. Global investors begin to treat Japan as a structural risk rather than a safe, developed economy. This amplifies volatility. Speculators target the currency even more aggressively. At the same time, regional partners start adjusting their policies to protect themselves from Japan's instability. This creates wider financial stress across Asia. Geopolitical risk rises because economic weakness reduces Japan's strategic options in the region. Then there is the third path, the most sensitive one. China decides to move more aggressively. It allows the yuan to weaken alongside the yen or uses financial tools to expand its influence further. Regional partners are offered trade incentives settled in yuan. Financial agreements bypass traditional Western channels. Quiet pressure is placed on smaller economies to align with Chinese systems. This shifts the balance not overnight, but steadily. Japan, already under pressure from a weak currency, faces a shrinking sphere of influence. Global markets sense a structural change. Instead of a single connected financial system, rival blocks start to harden. Trade flows begin to realign around these blocks. Investors are forced to pick sides. Each of these paths does not exist in isolation. They overlap. They influence one another. The final direction depends on decisions made in quiet central bank rooms and behind closed political doors, far away from public view. The collapse of the yen is not just a story about numbers on a currency chart. It is a story about power, pressure, and position. Japan is not only fighting inflation or defending its exchange rate, it is defending its place in a changing world order. At the same time, China is not only managing its own economy, it is testing how far it can push its influence inside a financial system that was built without it. This is why the falling yen is not a local issue. It is a geopolitical signal. For decades, global finance moved around a few powerful centers. The rules were mostly written and enforced by the same group of nations. Now that balance is starting to shift. A weak yen, slow policy responses, and China's growing financial reach are all connected to a much bigger change. This could become a turning point, not because one currency is falling, but because the structure around global money, trade and influence is slowly being reshaped in real time. What happens next depends on a few key moves. Watch the next Bank of Japan policy meetings and whether interest rates finally rise in a meaningful way. Watch how China manages the UN and whether it continues building trade and payment systems outside the traditional Western framework. Watch how the G7 responds. Will it coordinate again like in the past? Or will each country act alone in a more fragmented world? These are not small developments. They will decide how money flows, how power shifts, and how stable the global economy remains in the coming years. If you want to stay ahead of these changes and understand how global events connect beneath the surface, make sure you stay with us. Like this video if you found it useful and subscribe to our channel for more deep, clear, and powerful breakdowns of global finance and geopolitics.